Let me tell you a little bit about the format of our session this afternoon. I'll give a brief introduction to John, and then we're going to hear him speak on anything he wants. And then myself, and hopefully if Professor Richard Herring from the Finance Department comes, we'll have questions from him. We have Mukul Pandya, who is the head of our knowledge at Wharton. I myself am Jeremy Siegel, also from the Finance Department. And then we're going to have questions from the audience. So a three-part session this evening. I'll tell you, looking over John Thain's resume, it is truly incredible. There is only one major flaw, and that is that he went to Harvard Business School. I don't know, we may forgive you for that.
I didn't know better at the time.
You didn't know better at the time. Born in 1955 in Antioch, Illinois, 60 miles from Chicago. My hometown is Chicago, too, so we're both Midwesterners. By the way, you had all the qualities to go to Harvard. Valedictorian of his class, captain of the wrestling team, lead debater. But you were too smart to go to Harvard. You went to MIT. And got an engineering degree in 1973. And then after that, he succumbed and went to Harvard Business School and got his MBA in 1979. When he joined Goldman Sachs and rose up through the ranks all the way to president and chief operating officer during a very successful time for both him and Goldman Sachs. And then in 2004, he joined the New York Stock Exchange. That was after there was a slight controversy about a past president, Dick Grasso, who took a $140 million bonus, which some thought was excessive for a nonprofit quasi-government organization. He stilled that controversy and took the New York Stock Exchange even further as it was privatized. The process was started under Dick Grasso, and he continued it, and then saw through the merger with Euronext, very successful merger then that took place. And then in December 2007, he joined Merrill Lynch. And that began the interesting part of your life. Again, there was a little dissatisfaction with the prior CEO, Stan O'Neill, who was the head of Merrill, was being blamed for subprime losses. He said, don't worry about them. The losses will be held to about $1.5 billion. But that, of course, did not prove to be the case. So the situation was just beginning to get serious, but John took over at a very, very difficult time, both for the firm and for the financial system. As the subprime crisis worsened, I think John did a very smart thing and a very good thing, and probably the best thing that could have happened to Merrill. And that is he arranged a merger with Bank of America. Now, what was, I think, so foresighted about this is it was not like what Dick Fuld did for Lehman Brothers. He sort of waited until the price got to zero, and then it was too late to merge it into any company. John negotiated at an early stage. I guess Bank of America sort of had been taking interest in Merrill for a long time and thought that there would be very good synergies. The merger took place or it was announced. The merger took place later, but it was announced. I think it was the week that was. Am I right, John?
It was, correct.
A year ago, this dramatic week. Actually, we had last year a session that was meeting that week to try to explain what was happening. That was the week when Lehman went under. I think that very day is when the announcement of the merger between Bank of America and Merrill took place. AIG was rescued. On the next day, I remember debating that back and forth in our session. Would it go or would it not? I said they would rescue it because there's such chaos in the market. The money fund, the reserve primary money fund, broke below $1. Panic was in the market. This is probably going to be enshrined as one of the most notable weeks in history for the financial markets, and that's when the merger was announced. The merger price was $29 a share, and although that was only about half the price, I believe, of Merrill, that when you took over the company, it was still a 70% premium over the market price that Merrill was trading at the time the deal was announced, which valued the brokerage house at just under $50 billion. So, I don't know of anyone that could have done better for the shareholders. The shareholders of Merrill. If you're a shareholder of Bank of America.
That was my job.
Yeah, you're right. You were representing Merrill and did extremely well. I would say, as I said, the interesting part of John's life probably started when you took over Merrill. The very interesting part of your life happened after you, announced the merger with B of A. I know that John's going to talk about it, so. I don't want to spend any time, and there might, we're going to understand a little more what happened. Of course, losses mounted, really not due to John's mistakes, but mistakes that were made early on. Then there became a big controversy. Were these revealed to B of A shareholders on time? That's one. Then there was an issue of the bonuses. Big issue, it was with AIG too, but also there. Should they have been paid? Again. And then there is, the issue of the office. John is now enjoying retirement and is going to talk to us about the pleasures of playing golf and attending charity events. John, welcome our guest. Thank you.
Thank you very much, at least for most of that introduction. This is supposed to be a panel discussion, so I was going to talk only for a few minutes. I'll cover a few things. I really do want to talk a little bit about, why, at least in my view, this all happened, what was the cause of this. I do want to talk a little bit about some of the areas that I think need to be changed that aren't being focused on that much. I suppose because I have to, I'll deal a little bit with the losses and the bonuses, and if I really have to, my office. And then we'll open it up for questions. But I really want to answer questions and talk about what you guys want to hear about. I will say, though, that a year ago, really a couple of days before a year ago, I was in the Federal Reserve on Friday, Saturday, Sunday, and this was truly history in the making. And there will be lots of books written about this, and this will be studied for years and years and years here and at least some of those other business schools that deal in really important things. And it was a pretty amazing time. So I thought what I'd do is just talk a little bit about, at least in my view, how did this happen, and then what some of the things that need to be done, and I'll address these other little small problem issues for me. So let's start out with how did this happen? I think this was a pretty classic bubble. And you all, because you're at Wharton, probably already read Kindleberger's book. But if you didn't, you should, because what happened here is a pretty classic bubble. We're, of course, now in all of the repercussions of the bubble bursting and trying to figure out whose fault this is and who should be punished and how do we make sure this never happens again, which, of course, we won't make sure this never happens again because bubbles have been happening for hundreds of years of markets. But it was a classic bubble. It just happened to be particularly big. I think that the beginnings of the bubble really stem from the U.S. Federal Reserve's monetary policy. There was too much money available for too long of a time at too low of a cost. And that fueled excessive amounts of leverage in the housing market. It fueled excessive leverage in financial institutions, and it fueled excessive leverage in the private equity firms, and ultimately that fed into the stock market. There's plenty of blame to pass around, including Wall Street. But let's just talk a second about the housing market. So one of the problems in the housing market is mortgage originators get paid for originating mortgages, and they don't really care what happens to them after they get made. And so mortgage originators were originating mortgages with higher and higher loan-to-values, with lower and lower credit checks on the borrower, until ultimately we got to the point where the mortgage originators were totally in the dark. And you had 100% loan-to-value mortgages being made to people who had no jobs, no income, no assets. They started calling them ninja loans, no income, job, or assets. And those mortgages, the mortgage originators really didn't care because they really weren't regulated by much of anyone, and they got paid just for volume. So that's one place to look at. That's a problem that needs to be looked at. Second of all, the lenders themselves didn't really care because the lenders were able to push these mortgages, all of them, into the marketplace. So they didn't keep any of the pieces of them. And so one of the proposals that's being talked about now, which I think is a good one, is requiring lenders to keep at least some equity, some piece of these mortgages, so they have some responsibility and they do care what actually happens to them after they originate them. We, of course, had Fannie Mae and Freddie Mac, which you could spend an entire day on talking about the problems of having a government-sponsored entity whose actually original purpose was a good one. The idea that Fannie and Freddie should use their government-sponsored status to standardize mortgages and to guarantee them, making home ownership more affordable to people, that's a good thing. But making them a for-profit public company wasn't such a good thing because they then used their government status to grow a giant portfolio, which really didn't do anything to further their public purpose, but did in fact allow them to make a lot more money since they could fund their portfolio at government, slightly over government rates. And so their shareholders did better and their executives did better. And by the way, that's still an issue that has to be dealt with, what to do with Fannie Mae and Freddie Mac. We then get, of course, to Wall Street itself. Wall Street was securitizing all these mortgages, and as the credit quality deteriorated, Wall Street decided that we would make more and more complicated structures till we finally got to the point where no one understood them, certainly not the rating agencies, certainly not most of the buyers of them, and actually I think for the most part not very many people on Wall Street understood them. The best evidence of that was some of the Wall Street firms, including Merrill Lynch, who created a lot of these things, when it became more and more difficult to sell them, thought it would be just perfectly okay to pile them up on their balance sheet. And that turned out to be a very, very bad idea. But there's no question that as the securities themselves became much more complicated, the rating agencies completely failed in their jobs, rating big chunks of these things AAA. They had a tremendous amount of leverage built into the structures. If it was a corporation, they never would have rated a AAA corporation that had that much leverage. The prospectuses that these were sold under didn't even explain what the real collateral was inside of them. The buyers didn't understand what they were buying. And Wall Street was packaging these things up and selling them to make money, and then, of course, also piling them on their own balance sheet, which led to the ultimate destruction of several of the firms. There's also blame to go around on the regulatory side. You know, the regulators As the markets went up and as asset prices rose, the regulators allowed financial institutions to get more and more levered. So whether it's investment banks or commercial banks, the amount of leverage in those firms grew dramatically. That's a problem. Also, the policies on capital were also very pro-cyclical. By that, in a positive environment, when banks are earning money, where asset prices are rising, they were allowed to have less capital as a percentage of their total assets. And then, of course, as the market turned around and went the other way, then they needed to have more capital, which, of course, is exactly the wrong thing to do, because then they're forced to raise capital at the worst time to try to liquidate assets, and that caused the downturn to be even bigger. And we really haven't yet dealt with, I don't think, the regulatory structure that we really need to have to deal with these very large financial institutions, and I'll come back to that in a minute. We also had too much leverage in the private equity world. You know, the private equity firms were able to borrow more and more money. That also helped to drive stock prices up. And so, you know, what basically happened was a fundamental bubble that was driven by first monetary policy, but then ultimately all these other factors, and that bubble burst. And we're now in the mode of trying to deal with the damage of the bubble bursting, and what do we do to at least try to make sure that I don't think you can prevent bubbles from happening, but at least you can make sure they don't do as much damage as this particular one has done. So let me talk about a couple of things that I think we need to focus on. One is the regulatory framework in the United States. And I think it's unfortunate because one of the great things about crises, if there is anything good about them, is you can use them to make change. And at least at the moment, it doesn't seem to me we're going to make what are the fundamental changes in the regulatory structure in the US financial system. Why do we have the SEC and the CFTC? Why do we have the FDIC, the Fed, and the OCC? There really is no real attempt to consolidate and to eliminate the duplication in that regulatory structure. And we certainly, I don't think, have a mechanism to capture the gaps in those structures. When you have multiple regulators that are duplicative, you also create gaps, and that's one of the reasons AIG Financial Products was able to do what it did, which was basically write massive insurance contracts without any regulatory requirements whatsoever. So I think it's unfortunate, but I'm not very optimistic that we're really going to do something to create a more logical, less duplicative, less expensive, but also better regulatory structure for financial institutions. But I think that's an area that needs focus on. Second area I think needs focus on is the whole bonus structure on Wall Street, and that's getting a lot of attention. And I'll talk specifically just for a minute about Merrill, but I think it's more the concept. I don't think there's anything inherently evil about bonuses. Having compensation that's variable is better than having compensation that's fixed. So if you just pay people, X millions of dollars, no matter what they do, whether they perform well or not, and whether or not the companies perform well or not, that's not a good alternative. But I do think bonuses have to be tied much better to longer-term performance. They have to be tied better to the shareholders. And they also have to be tied to real results. And by that I mean, if I'm trading foreign exchange, and every day, at the end of every day, my positions are completely liquid and you can see what they're really worth, that's one thing to pay me based upon that. But if I'm creating AAA ABS CDOs and I'm marking them to market, but I'm building up a huge pile of them on my balance sheet, which ultimately leads to losses in the future, that's a totally different and much less high quality of earnings. And you want to pay people much different for that kind of thing. So you first have to take into account, well, what exactly is generating earnings? And then second of all, I think you have to make compensation and bonuses in particular longer term and more equity based, and then require that the stock be held for a long period of time. So, I think you'll see some of this happen. So you will see some of the firms use much more stock or stock-like things, make people hold them for very long periods of time. But that's not the only answer, and I think there's too much focus on the bonuses because actually Lehman, as well as Bear Stearns, had very high components of equity in their compensation structure and made their employees hold them for long periods of time, and that didn't do them the slightest bit of good. So I also think there has to be much better focus on risk management, because even if you have a compensation structure, if you don't have good risk controls, if you don't understand the risks that you're taking, if you allow traders or businesses to wipe out the earnings of all of the other employees of the firm, that undermines the entire compensation structure no matter what you have. And that was one of the problems at Merrill Lynch. Merrill Lynch, the losses that were generated in Merrill Lynch's P&L, almost all of them were mortgage and mortgage related. All of the people who created those losses either got fired before I got there or I fired. So I then have 60,000 people who are working in wealth management, working in investment banking, working in equity trading, basically all who are doing a good job, and every day come to work, and they're actually earning money in their businesses, and all of their efforts get wiped out by these legacy assets that were put on this balance sheet through really a complete breakdown of the risk controls, and none of the people are even there. So you have to tie compensation as well to good risk management, because otherwise you still have the problem of one group or one business blowing up the entire firm, which is what risk management is supposed to prevent. The other topic I'm going to cover is too big to fail. We have a problem in this country right now that the concept of moral hazard has been thrown away. We have the very large financial institutions right now who are too big to fail. Lehman's proven that they are, in fact, too big to fail. But we haven't, and so they have an implicit government guarantee. But we haven't done anything to change how they do business. We haven't done anything to change their regulatory requirements. We certainly, I don't think, have any intention of breaking them up so that they're smaller. And there isn't any formula right now to actually make them pay for that implicit government protection. The FDIC charges for deposit insurance. Right now, we have implicit government insurance of these big financial institutions that they don't pay for, and they, at least so far, haven't changed their behavior. I think that is a potential problem in the future. All right, I'll cover a couple of Merrill things since you brought them up at the beginning. It'll save you all from asking. Easiest one is the bonuses. All right, when we negotiated the deal in September, and in September there was no TARP money, there was no government injection of capital into any of the financial institutions, we negotiated really four main things. We negotiated the price, we negotiated the bonuses, and actually the fourth one doesn't really matter. The third thing we negotiated was the material adverse change clause. So as part of the deal on that September weekend, Bank of America agreed then that we could pay, and the number is actually they agreed to pay up to $5.8 billion of bonuses. And they did that for what they now say is the obvious reason that you have 60,000 people. If you don't pay them anything, they have alternatives and they'll leave. And since the company basically is a people business, you can't just not pay 60,000 people anything, or they'll go find alternative places to work where they will pay them. So they agreed in September that we could pay up to $5.8 billion of bonuses. They were totally involved in the process to do that. I'll just give you some of the details just for fun. When we agreed in September, it was supposed to be 70% cash, 30% stock. They asked us, 60% cash, 40% stock. They asked us to change it to 70-30, which we did. We ultimately changed 5.8 to 3.6 billion because we were trying to at least reflect somewhat what was happening both in the market as well as at Merrill. They asked us to use their stock instead of Merrill stock, so it's a little interesting in January where they claimed they didn't know anything about these bonuses since we used their stock to pay them. And basically, when I got fired in January, where they said John Thain secretly accelerated these bonuses, they were lying. And that has now trapped them into a lot of trouble because there's a piece of paper, there's a document that says that, yes, they in fact agreed to this in September. So one takeaway for all of you is it's really always better just to tell the truth. The losses, when I thought Lehman was going to go bankrupt, believed at the time that that was going to be catastrophic in the marketplace, which unfortunately turned out to be true, but I also thought it would be catastrophic to Merrill Lynch because of the amount of bad assets we had on our balance sheet. So the idea that we were going to lose money in the fourth quarter after Lehman went bankrupt is, well, that's why we sold the company. If we were going to make money, we wouldn't have sold the company. So I don't think there was any question that given the complete shutdown in the credit markets and given the amount of bad assets around our balance sheet, we're going to lose money. You know, did we lose more than maybe Bank of America thought we were going to lose? Well, probably. But the market was really, really bad. And a lot of those losses actually were just mark-to-market losses, and actually a lot of them have come back, and actually Merrill Lynch contributed the vast majority of Bank of America's earnings in the first quarter, and part of that was just these losses being reversed. So I don't think there was anything particularly surprising other than perhaps the overall size, but the idea that we're going to lose money in the fourth quarter was pretty obvious, I think. And the last thing, since you brought it up, I'll talk about my office. So you all learn lessons from people who make mistakes. So I joined Merrill Lynch in December of 2007. That was before Bear Stearns, before the world imploded, before there was any government money. And you know, I used my office to receive clients, to receive guests. I use it as a meeting space. And the way the office had been set up, had a big desk right in the middle, so it didn't have seating space. You couldn't really receive clients. And also, one of the conference rooms had been converted into a private gym. And if I want to work out, I don't need to work out at the office. I can work out at home or in a real gym. So we tore out the private gym. We reconfigured the office so that it was like a normal office where you could have guests and have meetings. And we decorated it in kind of the style that Merrill Lynch offices were, which were very, very nice. Now, in hindsight, that was a mistake. All right, I admit that was a mistake. I didn't know the world was going to explode, but it did, and that was a mistake. And I'm sorry that I did that. And if I had that to do over again, you know, I'd furnish it in IKEA. But I also did as much as I could do to correct that mistake. So there was no government money that went to pay for any of that stuff, ever, no matter what certain politicians say. But I also said, given what happened, and given it clearly was a mistake, I reimbursed the company for the full cost of all those renovations. So, you know, I believe in doing the right thing. And that was a mistake, and so I corrected it to the extent that I could, and so it didn't cost the shareholders any money either. And by the way, just for all of you who, if you watch TV or whatever, a commode is not a toilet. A commode is a chest of drawers. So, anyways, so. So I still recommend, if you're going to go to a financial institution in difficulties, do not, just go to IKEA or keep the furniture that's there. Anyways, so that's, I'm happy to answer whatever questions you have. Thank you.
John, would you like to keep standing there?
What's that?
Would you like to continue?